Trend reversal chart patterns are a game changer for traders. Spotting them early can help you exit before a trend collapses, or enter right before a new trend begins. They're one of the most powerful tools for timing the market with precision. Welcome, smart traders. In this video, we'll break down trend reversal patterns, what they are, how to identify them, and most importantly, how to trade them. We'll cover different types like double top, head and shoulder, and more, with real chart examples to show you exactly how they work in live markets. Let's get into it. The head and shoulders is a trend reversal pattern that signals the end of an uptrend and the potential beginning of a downtrend. In a head and shoulders chart pattern, three peaks are formed. The peaks on the left and right are called the shoulders, and the higher peak in the middle is known as the head. The neckline is the support level that connects the lows between the peaks. When the price breaks below the neckline, it signals a potential trend reversal. At this point, you can either enter a sell position immediately after the breakout, or wait for a pullback to the neckline. If the price shows signs of rejection at the neckline during the retest, it provides a safer opportunity to open a sell trade. An inverse head and shoulders pattern consists of three troughs. The two low troughs on the left and right are called the shoulders, and the lower trough in the middle is known as the head. Let's take a look at a real market chart example. The neckline is the resistance level that connects the highs between the troughs. When the price breaks above the neckline, it signals a potential bullish trend reversal. You can either enter a buy position immediately after the breakout, or wait for a pullback to the neckline. If the price shows signs of rejection from the neckline during the retest, it provides a more conservative and potentially safer entry for a buy trade. The inverse head and shoulders pattern forms at the bottom of a downtrend and signals a potential reversal to an uptrend, indicating a possible buying opportunity. Let's take a look at a real market chart example. In this scenario, an inverse head and shoulders pattern formed at the bottom of a downtrend, indicating a potential bullish reversal. After the pattern completed, the price broke above the neckline, confirming the breakout. At this point, there are two possible entry strategies. Enter a buy trade on the candle close above the neckline. Or, for a more conservative approach, wait for the price to pull back to the neckline and look for a bullish candlestick confirmation. As we can see, a gravestone doji formed at the neckline level. If you haven't watched my video on candlestick patterns, make sure to check it out. Just click the link in the top right corner of the screen. Once a confirmation candle forms near the neckline, that becomes our entry point for a buy position. Place your stop loss below the low of the confirmation candle, and aim for the next key resistance level as your take profit target. The next pattern is the double top. This pattern consists of two distinct peaks formed at approximately the same price level, with a support line located below the two highs. The double top is a bearish reversal pattern that typically forms at the top of an uptrend and signals a potential shift toward a downtrend. When the price breaks below the support line, the pattern is confirmed. If the price then pulls back to retest the broken support line and shows signs of rejection, this presents a high probability sell opportunity, as it suggests the bullish trend has likely ended and a downtrend may be starting. Conversely, the double bottom is a chart pattern that consists of two troughs formed at nearly the same price level, with a resistance line positioned above them. The double bottom typically forms at the end of a downtrend and signals a potential bullish reversal. A breakout above the resistance line confirms the pattern. If the price then pulls back to retest the resistance line and shows signs of rejection, it presents a potential buy opportunity, as there is a high probability that the price may continue moving upward from this level. Let's look at a real market chart example of the double bottom pattern. In this example, a double bottom formed, signaling that the downtrend is weakening and a potential reversal to the upside may occur. The price then broke above the resistance line, confirming the pattern. This breakout suggests a high probability that the market may shift from a bearish trend to a bullish trend. A bullish confirmation candle formed at the retest of the resistance line, indicating a valid entry point for a buy position. Place your stop loss just below the low of the confirmation candle to manage risk. Set your take profit near the next key resistance area to secure potential gains. Next, we have the triple top pattern, which functions similarly to the double top but consists of three distinct peaks formed at approximately the same price level. A support line is drawn by connecting the lows between the peaks. The triple top is considered a stronger bearish reversal pattern, especially when it forms at the top of an uptrend. When the price breaks below the support line and shows signs of rejection to the downside during a retest, this provides a potential entry point for a sell position, as there is a high probability that the price may continue moving downward from this level. Conversely, the triple bottom pattern is similar to the double bottom but consists of three distinct troughs formed at approximately the same price level. A resistance line is drawn by connecting the highs between the troughs. The triple bottom is a bullish reversal pattern that typically forms at the end of a downtrend, signaling a potential shift to an uptrend. When the price breaks above the resistance line, the pattern is confirmed. We then wait for a pullback to the resistance line, and if the price shows signs of rejection from the downside, it presents a buying opportunity, as there is a high probability that the market may reverse from a bearish to a bullish trend. Let's look at a real market chart example. In this example, a triple top pattern formed, indicating strong resistance and a weakening bullish trend. After the third peak, the price broke below the support line, confirming the pattern and signaling a potential bearish reversal. There are two ways to enter the trade. Enter on the breakout candle that closes below the support line. Or, wait for the price to pull back to retest the support line, which now acts as resistance, and look for a bearish candlestick pattern as confirmation, or a rejection wick. Once confirmation is in place, this becomes your entry point for a sell position. Place your stop loss just above the high of the confirmation candle to manage risk. Set your take profit at the next significant support zone, ensuring a favorable risk-to-reward ratio. The next trend reversal pattern is the rising wedge. In this pattern, the price forms higher highs and higher lows, but within a narrowing range, indicating weakening bullish momentum. When a rising wedge forms during an uptrend, it signals a potential bearish reversal. The pattern is confirmed when the price breaks below the lower trend line. At this point, it's important to wait for a retest of the broken trend line and look for rejection signals, such as bearish candlestick patterns. This setup presents a high probability sell opportunity, as the price is likely to reverse and move in the downward direction following the breakdown of the wedge structure. Similarly, the falling wedge is a bullish reversal pattern, where the price forms lower highs and lower lows within a narrowing downward range. When a falling wedge forms at the bottom of a downtrend, it indicates weakening bearish momentum and the potential start of a bullish trend. The pattern is confirmed when the price breaks above the upper trend line. At this point, it's important to wait for a pullback to the broken trend line and observe for bullish rejection signals, such as a bullish candlestick pattern. This presents a buying opportunity, as there is a high probability that the price may continue moving upward from this level. Let's look at a real market chart example for the wedge pattern. In this scenario, a rising wedge formed at the top of a bullish trend, signaling a potential trend reversal. The price then broke below the lower trend line, confirming the pattern and indicating a shift in momentum from bullish to bearish. There are two possible entry strategies. Enter a sell position on the candle that closes below the lower trend line, the breakout candle. Alternatively, wait for a pullback to the lower trend line, which now acts as a resistance level, and look for bearish rejection or candlestick confirmation before entering. In this case we enter on the breakout candle. Place your stop loss above the last swing high within the wedge structure. Set your take profit at the next key support level. This approach allows you to trade with confirmation and discipline, increasing the probability of a successful setup. Thanks for watching, and remember, successful trading involves more waiting than actual trading. Patience and discipline are essential, as following your strategy consistently is key to becoming a profitable trader over the long term. If you learned something new today, don't forget to hit the like button, subscribe for more such strategies, and turn on notifications so you never miss an upload. See you in the next video.